Who's really happy is the market, because the market's gone up thousands of points over the last 4 or 5 days since hearing about it. And the Strait is going to be opening. It's already partially opened. It's going to be opening up soon in full over the next day or two. And the market has gone wild, and oil has come tumbling down. Oil is at $73 to $74, and it's getting to very close to where it was before the crisis. The difference is now we have Iran without a nuclear weapon. So we'll see how that all plays out.
That was President Trump just moments ago. And check out oil prices, give or take, 74, 75, they're 76, 76.55, Vice Brent 79. Joining us now, Daan Struyven, Goldman Sachs, co-head of Global Commodity Research. And I'll tell you, I don't know how you do it, Don. You had a higher forecast. You've gone to 75 for your forecast now. But it's for the year, so I'm kind of needling you a little, but that's where it is right now. So, but that is your forecast?
That's right. So for WTI, our base case is that prices stay close to current levels, $75 by year end, and then moderate somewhat further to 70 for next year, which is our long-term fair value estimate for WTI. You know,
Santelli yesterday was, he listens closely, and there's times when he disagrees with what's being said. Doesn't say anything at the time, but yesterday he kind of went off on all the conjecture that oil would not fall quickly, that there were close-ins, shut-ins that are going to be hard to restart, and that there's at least 3 to 6 months after the Strait reopens before you got back down to levels like this. That's not what happened. Why?
The outlook for Middle Eastern supply remains tremendously uncertain. The most important question is, will flows through the Strait recover significantly? And then once flows recover, how quickly can production come back?
Why did it drop from 95 to 75 overnight, basically?
The market, I think, is pricing in our base case for a relatively rapid recovery in exports from the region. We see exports of oil from the region back to normal levels by the end of July, which is consistent with the roughly 30 days normalization timeline that was part of the memorandum of understanding that was released in the press today. And then in the second stage, we assume production, so actual oil production, recovers to pre-war levels by October, so somewhat later than the exports. One reason why we get there relatively quickly is we do think that the UAE and Saudi Arabia had meaningful spare capacity before the war, because inventories are low now, and because they are focused on stabilizing markets. We think they will bring production back to above pre-war levels.
Let me ask you, how important is it for Iran to be able to start selling its oil on the open market? I mean, because if the key that we're looking at this point is just the reopening of the Strait and keeping that Strait open, is that enough of an incentive for Iran to not go back and say, we're going to try and close the Strait again?
Yeah. Oil remains by far the most significant source of revenues and of exports for Iran. According to the Memorandum of Understanding text that was released, sanctions would see a waiver upon signing of the MOU. So I think that's one of the reasons why Iran is accepting this deal.
Right. How incentivized would they be to make sure that they are not going back in 60 days or doing any of these things, because it would be shooting themselves in the foot as well?
Yes. From a rational perspective, we do think that it's in the interest of both parties to resume flows to provide energy to the world, but the uncertainty remains very large. Will the Strait reopen? Will it reopen fully? Once it's open, will it remain open? We do see the risk to our base case for prices as still skewed to the upside, because we cannot be confident that the Strait fully stays open for the indefinite future.
President Trump say he's going to bomb them again if he doesn't like what happens in that, because that's his leverage point. That's his cudgel. The Iranians' best cudgel to this point has been to close the Strait, which, again, shoots themselves while they're doing it, but they have a higher threshold for pain. I won't suggest that there's necessarily all rational decisions that are being made on their part. But
one other reason why Iran may have been more open to signing an MOU now than a few weeks ago is that total exports from the region have risen from the start of the war from about 30% of normal levels to now almost 50% of levels. So over time,
wasn't all that effective anyway.
That's right. Extra flows via pipelines, dark transfer. So over time, the more oil gets out to the rest of the world, the less leverage Iran has.
So would you have a 2027 average price of 60 or 65?
So for next year, our 2027 annual average price forecast for WTI is 70, for Brent 75, in line with our long-term average. On the positive side for prices, the starting point for inventories in early 2027 will be low because of all the Middle Eastern supply losses. Also on the positive side for prices, we think there should be a security premium because supply disruption risk will remain high. On the negative side for prices, we do forecast a large surplus next year because of strong supply growth in the Americas. That's one reason why the oil market has been able to manage the largest oil supply shock ever. It's very strong supply growth from the Americas.
Could sell it. It'd be great if we could sell it, but they're not going to sell it for less than it's worth. That's the problem. If it's 85, they're like ka-ching. And right now, are 90. So Saudi Arabia, and you said that they can ramp up. When you ramp it up as quickly, I'll take 70, 76 all day long from the Saudis, right?
Yep.
Get it while it's hot. So they will sell into that.
We do think so. We think that Saudi Arabia, as the leader of the OPEC Plus group, is focused on stabilizing markets. When inventory levels are low, you want to produce more volumes to normalize.
And 70
levels.
all next year, we should buy some Exxon or something, I think, right? If we could, but we can't. I mean, that's not a bad price at this point. But it's not going below, you don't think it goes below 70. It doesn't go back to under 60, for example. Ever?
It's possible if more of the demand losses that we're currently seeing, oil demand is down 5 million barrels per day, if more of these losses linger and continue. Our base case is that most of the demand comes back, but that is a downside risk to the price outlook because of the downside risk to demand.